So welcome to our ECO, SCO and FSA program presentation. I'm Corey with KW Insurance. I'm going to walk you through some of the FSA programs and why we still think PLC is where you probably should be in that. ECO is a new option. It's just like SCO, except that allows you to up your coverage to 95% of what your average yield is in the farm. So kind of a game-changing thing for eliminating risk. We'll walk you through how it would have paid out historically, which we can run through our quoter on pretty much every county here that surrounds us anyways. So if you want to rehash this presentation or look up any other information concerning our crop insurance education type stuff, just go to kwsunburst.com. On there, there's an education tab and you can kind of re-watch or look through any of the presentations that we've done in the past. So first, the decision you need to make right now at the FSA is whether you're going to be in the PLC or ARC for the 2021 crop year. This is a forecast thing. Available through the FSA site actually that plugs in different model runs using right now, like this model is the highest price wheat run that they have in there. And even with the high wheat prices, you can see we have the orange color here would be ARC, the red color would be PLC. It basically shows neither one of those programs if the prices stay up around $5.40 a bushel are going to trigger very big payments, but it still shows PLC with the higher end of the payment range. This last year here for 2019, obviously, ARC paid a little bit, but PLC paid substantially more. This is the highest model run they have. This is the average model run that they would predict for pricing going forward. So these prices are determined every year by averaging all the wheat sales in the U.S., throwing them all into one pot between the winter wheat, spring wheat, and Durham and everything, and then coming up with this national average price or market year average price, they call it, for triggering PLC and ARC. Long story short, right now we might be at $6 winter wheat here in Sunburst. That might only be $5 winter wheat in the Midwest, and all of those prices are getting averaged together to come up with this. So even at our elevated market price right now, it's possible the PLC could trigger going forward into 2021. The other thing about the PLC ARC decision is if you sign up for ARC, you can't be an SCO on the crop insurance side. I think when you guys see how much SCO paid out and the fact that it pays on all your seeded acres, not just your base acres, I think that will pretty well make your mind up on this PLC ARC thing. So if I were you, I'd pick PLC. I think, granted, we're in a bit of a run up in the market now, but I think when you average the national wheat price still, even where we're at, it would possibly still trigger a little bit of a payment there. So on this other thing with the PLC ARC decision, your ARC base price is a 5-year Olympic average of the last 5 years of the market year average prices. As you can see, they were all 550s for wheat for the last 5 years, which means that program bottomed out for 5 years in a row as far as the average wheat price. That's a reflection of how tough things have been, of course, but to get that price to jump up, even if next year one of these averaged $20 a bushel for wheat, it would get thrown out because they throw out the high and the low on that average. So for at least the next 2 years, ARC is going to be stuck at a bottomed out base price, which makes that even harder to get paid, which we'll go through why that is here. And the other thing that's happened is our ARC county yields have gone down in a lot of the counties around us because we've had some drier years. So you can see here are the trend adjusted yields that they're going to use to figure your ARC guarantee. In 2015, we had a 28, 2016, it was a 39, it looks like, and then a 31, a 28, and a 34. Long story short, that made your 2021 benchmark yield for ARC now, what they're going to use for next year, only 32 bushels an acre. The lower that yield gets, the harder it is to get paid on ARC, because on the ARC program, we have to get down to 86% of the county's average for you to start to get paid there. On SCO, we're still working off of a yield that's closer to 40 bushels for our county for wheat, and so that alone gives you a lot better chance of getting paid on SCO versus ARC. So what happens on the SCO side, the crop insurance side, if the price goes up at harvest? We're going to say we had a base price of $5 a bushel this spring for spring wheat, and the county had a 30 bushel county yield for the SCO program. So every crop on SCO is going to have its own county yield. That means that they're expecting $150 an acre of revenue for spring wheat in Toole County, to make this simple. At harvest, we only cut 20 bushels, so we hit kind of a drought. This is where you really need SCO or ARC to trigger, right? But the price of wheat, we're going to say, went up to $10 a bushel. So our revenue guarantee, when the price goes up on the harvest price on crop insurance, they go back and they refigure our projected revenue per acre. So now our projected revenue for the county, instead of using the base price, is using the harvest price. This is what happens when the price goes up. So we'd have a $300 an acre projected revenue. The 20 bushels we cut is now worth $200 a bushel, right? That's 20 times 10 bucks. They would take the $200 we harvested, divide it into the $300 guarantee, and they'd say the county only came in at 67% average in this scenario. To get paid on SCO, you just have to have the county come in. If you want all your money out of SCO, the county, if it comes in below what your underlying crop insurance level is, you get all your money. So in this scenario, we'd get 100% of our SCO guarantee. Now, in this same scenario, let's say we switch to the ARC program. So we have a base price of $5 a bushel at seeding times the county yield of 30 bushels, so $150 an acre revenue projected for the county. You're going to have, as of right now anyways, a lower base price on ARC than we're going to have on SCO, just because, remember, we're stuck at that $5.50 a bushel on ARC because of how the Olympic averaging works. But regardless, the programs figure sort of the same way, except for one major difference, which I'm going to get into here. So same scenario, the county only came in at 20 bushels an acre for wheat on average for the county. The price increased to 10 bucks a bushel. What happens on ARC though is your projected revenue doesn't ramp up. Remember, it went up to $300 on the multi-peril crop insurance side. On ARC, it's stuck there at that $150. They don't increase that part. You take your 20 bushels of production then, it's still valued at 10 bucks a bushel because they do come up with a harvest price. So you have a $200 worth of wheat production that they're claiming on that program. But your expected revenue doesn't ramp up when the price goes up. So now the county thinks, even though we cut 20 bushel yield on a 30 bushel average wheat crop here, because the price went up, they think we realized 133% of what we expected for revenue. Because of that, there will be no ARC payment because it has to come in under 86%. So long story short, because the price is suppressed so far on ARC, and it's going to take a while to drag that up with that Olympic averaging, unless they change that base price for PLC and ARC, it's going to be really hard to get paid on that program. And this is just one more reason why it's difficult for that payment to work out. So what is this extended coverage option? This is the new option that we can stack on your spring crops on top of SCO and your underlying coverage for the crop insurance. It allows you to insure up to the 95% level. Remember SCO, which you guys that have watched our presentations in the past, that allowed us to insure our farm up to the 86% level, which is triggered on the county level. And then ECO is 86% all the way up to 95%. So now we can insure all the way to 95% of what our average yields are on each unit on the farm on a county triggered program. The other big thing with these programs is they're based off your actual seeded acres, not off the base acres. So for you guys that are cropping a lot of acres or are not fallowing much anymore, you know your base acres don't reflect even close to what you're actually seeding. These two county triggered programs do. It uses county average yields to trigger payments, provides revenue protection. So sometimes the market might drop, which is what's triggered SCO a fair amount in the past year. We might have had a 20% market decline, but cut an average crop kind of for the county, and we still get almost all of our SCO money just because the market fell out. So a good way to protect yourself, not only on a yield loss, a drought loss in the county, but some big market swings. The big difference between SCO and this new ECO is that SCO, the government pays 65% of your premium. On ECO, they're only paying 44%. So for that reason, you'll see as we go through these examples, if you're going to pick one or the other, I would still stick with SCO because I think it's your best bang for your buck. ECO is going to trigger more often, but it's going to be more expensive. The two of them together can really be a home run in some bad years, which you're going to see in the scenarios as we go forward here. So ECO is available on crops this spring. One crop it won't be available on is spring wheat, because they're spring wheat or durum, any of the wheat types, because those are fall crops as far as changes go. So we won't be able to get that added on to wheat until next fall, but all the other crops, the peas, the chickpeas, lentils, canola, all the spring crops, the barleys, we can add ECO onto this year. So Once again, SCO is triggered by the county, not by your individual farm performance. It's triggered once the county gets below 86% of its revenue, projected revenue. Full payout when the county reaches multi-peril coverage election levels. So if your underlying level is 75%, if the county gets down below 75% average on any crop, you get all of your SCO money. And it's triggered by crop and type. Same thing on ECO, works exactly like SCO, except it's a 95% trigger. So once the county gets below 95% average, it starts to pay. When it gets to 86% average, where the SCO would start to kick in, then it pays out completely on its guarantees on your unit. We're going to go through how it pays unit by unit too, so you guys get a better grasp of how this program will work. And it's triggered by crop and price. So the cool thing about stacking PLC and SCO together is that we can get paid on the FSA side for their disaster programs because the prices are suppressed for PLC. We can get paid on SCO either on a yield decline, or maybe it's, like I said, a major market decline and we still have pretty good yields in the county, but SCO will trigger to fill your gap between your individual insurance and 86%. So now we can also stack ECO on top of that. So in theory, if things really went south, especially market-wise, right, we could get an SCO payment to fill our gap to 86%, an ECO payment to fill it up to 95% of what our average is, and then PLC would kick in to fill the gap in the pricing as well. So we could actually realize higher than 100% of what we were projecting for revenue for the farm by stacking these programs together. It should really be a big benefit if we had some more years like the last 4 or 5. Like we discussed before, it's a county-based program, so every county has its own yields for barley or wheat or peas. One thing is those yields are all thrown together into one big pot. So like the smooth peas, the lentils, and the chickpeas are all thrown into one big pot, averaged out to come up with an average yield for the county, and then you'd get your average harvest yield the same way by blending those products together. But then there's separate pricing on each crop, which we'll get into. So SCO uses crop insurance yields for the county to determine approved yields and harvest yields. So whatever you guys report on your production reports, that's how they're obtaining what they'll use for the harvest yields for these crops. Way more accurate, or it should be more accurate than those NAS surveys were, for sure. Must have signed up for PLC, not ARC, to be eligible for that crop. And crops with no base acres are eligible as well. So that's a big deal if you have some big chunks of land where CRP came out or something. All the base has gone off of that. This still allows you to be basically in a bought-in disaster program for those counties if things go south. Eligible commodities for SCO, pretty much everything we can insure now, other than rangeland, basically, we can throw into that program. It increases your total guarantee up to 86% of what your averages are on every unit. That's a big deal if your bank is basing what they're lending you off of your crop insurance guarantees, of course, especially, and eliminates a large amount of risk on the downside for you guys. This new ECO program, one more time, uses the same yields that SCO uses to determine the average yield for the county and your harvest yields. It'll be available on every crop except for wheat, and wheat will be added this fall. The one other caveat on SCO, or ECO, I mean, is that you don't have to be in PLC to be eligible for that crop. So it's not tied to FSA programs like SCO is. And eligible commodities would be pretty much any crop we can insure. It increases your total guarantee to 95% of what your average yield is. So we're going to focus on just Toole County here as an example. And we're going to throw up some crops here. So each crop, with all the types combined, has its own base yield for the county. That yield's going to ramp up and down just like your individual units would when we have good or bad years in the county, right? So there's a running yield tally in the back end for wheat in Toole County, which is about 40 bushels an acre. So we're going to focus on wheat here. We've got a base price that's set in February, which is happening right now if you're watching this program not after too long after it was released. And so we're going to say our base price for spring wheat over the whole month of February, using the September futures, averaged out at $6 a bushel. The spring wheat at harvest, when we averaged that through the whole month of harvest using the futures market, averaged out at $5 per bushel. So we had a decline in the spring wheat market of $1 a bushel. On winter wheat though, we had started at $5. So the winter wheat was averaged in the fall prior to that, right? The market was still suppressed at that point. So winter wheat averaged $5 a bushel for our crop insurance end of things. We're going to say it went up to $5.50 a bushel then at harvest. So the point of this slide is to show you guys that even though it averages all the yields together for wheat in the county to come up with your average yield for your guarantee and your harvest yield, the prices fluctuate separate by type on this program. So it might be that spring wheat here had a major decline. It might trigger a payment on SCO and ECO, and winter wheat may not if we had an average yield in the county. So it still reflects by type whether you lost revenue. The county's expected revenue was set then at $6 a bushel. Remember, that was our base price times our $40 or 40 bushel average yield. So they're saying in Toole County, we expect we're going to gross $240 an acre on spring wheat, $5 a bushel for winter wheat, remember, using the same 40 bushel yield, so $200 an acre on winter wheat. So in this example, we're going to focus on spring wheat. We get to harvest time then, and they're going to take all the yields you guys report on spring wheat, winter wheat, and durum, average them all together, and then we come up in this scenario with a 35 bushel an acre average for crops. So how are they going to figure what percent the county came in of average then? So remember in our example, spring wheat went down from $6 a bushel down to $5. They're going to take the yield then that the county harvested of 35 bushels times the $5 a bushel harvest price to come up with $175 an acre for revenue for the county. We were projecting $240, remember, using our higher base price and our higher yield. We'll divide those two out, and that means the county came in at 73% of what it was predicting or projecting for revenue. This is the number that we use for SCO and ECO to figure whether we're going to trigger payments, whether you get all of the payment or part of the payment. So SCO then, remember, is filling that gap between our individual farm coverage level, which in this scenario, we're going to say you elected wheat, revenue protection at 75% for your individual coverage. So it's going to bridge that gap all the way up to 86%, between 75 and 86. So in this scenario, you take the 86% that SCO is covering up to, minus your individual coverage of 75%, leaves us an 11% gap in there that we're insuring using the county-based trigger, right? So here's our example on, this is actually our farm, but we're going to say that there's 4 different units of wheat here that are seeded. This one has a 25 bushel average, this one has a 30, this one has a 28, and this one has a 35. Point being is, obviously, on every one of your guys' farms, there are different yields depending on where you seed the crop, right, for what you have for averages. The yields have nothing to do with whether this program triggers or not. That's all based on the county, remember. But once it triggers, the more acres you have seeded in a higher unit, it's going to trigger bigger payments on the higher average units than it is on the lower. But it's going to trigger all through the whole farm, which I'll walk you through that example in the end here. So we're going to focus on this 35 bushel an acre average unit. Remember, 11% of that 35 bushel average is covered under SCO. So we have 3.85 bushels covered under SCO times the $6 a bushel base price. So $23 an acre is our SCO guarantee on this unit. One other thing that's important to mention is if for some reason wheat was to go up to $10 at harvest for the harvest price on this, your guarantee on the SCO would ramp up in step with that. So you're only paying premium on this $23 an acre. If wheat was to go to $10, you would take 3.85 times $10, or you'd all of a sudden have a $38 a bushel guarantee that could trigger on here. So that's the other part of the revenue protection, is that you're only paying for a $6 a bushel base price, but it could ramp up to double of that on the insurance as far as what you could get paid in the fall. So if we ever hit a big drought and a market run up, this program could pay buku bucks, basically. So remember, we came in at 73% average for spring Toole County in this example. How do we figure our payment? So our SCO trigger starts at 86%. Once that county average comes in below 86%, we start to get paid. In this scenario, we came in at 73% average, so we were 13% below our SCO trigger. 13% more than fills our 11% gap, right? So once we get more than 11% below the 86%, then we get all of our SCO money. So we're below that, right? Once we hit 11% below 86, we'd get all of it. At 13%, we don't get any more money, but it just continues to trigger every unit on the farm. So in this scenario, we get all our SCO money on all acres of spring wheat on this farm. We had a $23 an acre guarantee on that one unit, right? So we're going to get 23 bucks an acre there, but what about the other units? So when we come into this slide, that just shows you on a 30 bushel average, we had a $20 guarantee. So for every acre in this unit, we're going to get 20 bucks an acre. This 28 bushel unit, we had an $18 guarantee roughly, we're going to get 18 bucks on all the acres seeded in that unit. And it's just going to pay out over every unit of spring wheat over the whole farm. So what if we hit 80%? So in this example, our SCO trigger starts at 86%. The county came in at 80% average. So we're only 6% now below our SCO trigger level, right? Remember, to get paid all the way out, we need to get to 11% below that. So how do they figure how much of that guarantee they're going to pay you then? Well, you're 6/11ths into getting all of your money out of it, right? So they're going to take the 6% that you're below, or 6 points below, divide it into the 11 that we'd have to get all of your guarantee, and that then would be 55% of the payment that we're eligible for. So we get 55% of the $23 an acre, or we get $12.65 an acre on this unit. And then it would prorate every unit on your farm out to 55% of what your guarantee yield was on there. So you can see now, instead of that last one, I think we got 30 bucks an acre here. Now we get 55% of the 20 or 11 bucks an acre basically there. So what does it cost to SCOs? Usually between 12 and 15% of your guarantee. $20 an acre guarantee would equal to 50 to 3 bucks an acre. That's what we're seeing on dryland wheat, usually somewhere in that ballpark. Each crop type have different premium rates, but they're usually in this ballpark. ECO then, though, is usually around 25% of what your guarantee is you're paying in premium, but the odds of it triggering are so much higher, right? Because it only has to get below a 95% average. So long story short, SCO needs to trigger about once every 8 years completely to get your premium back out of it. ECO more like once every 4 years. As you're going to see in all these examples that I'm going to run here, they both trigger pretty good sized payments consistently because of the market fluctuation as well. So here's the historical payouts. This is probably the part you guys are most interested in. Like, how does my county stack up in these programs, basically? So Toole County canola. So I'm going to start out with Toole County first. We've had 5 pretty substantial drought years, not substantial drought years, but some challenging years in here in Toole County, and some market swings, right? So on canola, the first scenario that I'm running here is SCO and ECO together. So you bought both products in Toole County. On each one of these slides, you're going to see I have a 5-year return going backwards as to what actually happened back in those years using our quoter. So it's cool. They set up this program where we can run all these programs backwards and tell you guys how they would have paid out had you been in them back then. So $47 in premium total over 5 years to be an SCO and ECO on canola in Toole County in this example. That would have paid out $198 an acre for the $47 in premium, or you would have netted $151 an acre over a 5-year period total for SCO and ECO in Toole County. This chart down here, the green bars are showing you when ECO triggers and how much it triggered. The yellow bars are SCO triggering and how much it triggered. So you can see it triggered total payouts on these programs for 4 years, and ECO is the only one that would have paid back in 2016 in this example. So as we go through, focus on these slides, the net dollars is kind of one of the things you want to focus on. Look at those bars, which I'll point out, and they're going to show you how many years actually this program triggered. You're going to see some of the time, SCO may have only triggered 1 year, but you still net out dollars ahead on this program. So this is just SCO, not stacking ECO and SCO on top. You can see you would have paid 17 bucks in premium here, netted $83. It would have triggered 4 out of 5 years in the last 5 years in Toole County. Toole County lentils, it would have netted $161 above what you paid into premium. Triggered every year on ECO, and partially there's little SCO payments a couple years and full SCO payments 2 others. So even if you would have just elected SCO in this example, you still would have netted out at another $82 an acre And the premium's lower when you just do SCO, right? It's only 24 bucks an acre in premium, but the two stacked together can make some substantial differences when we have some difficult years here. So how about your 5-year return on barley in Tula County? This quarter, the one issue it's having is it's not using the right markets for barley. It actually triggered in 2019 as well, but regardless, even showing not a 2019 trigger for barley here, ECO would have triggered every year, SCO 3 out of 5 years, and we would have netted $163 an acre above what we paid into premium over a 5-year period here with barley in Tula County. Just SCO, $74 net, only triggered in 3 years, and you still come out ahead, quite a ways ahead of the premium. As you can see, Tula County, we can't quote ECO backwards because it's not available on wheat yet, so they don't have premium rating for that. But for Tula County, we have a $63 net still on wheat, so we only paid 12 bucks into premium. We had a $75 payout. This is only using about a 30 bushel wheat yield unit, and you'd still net out $63 an acre. The one other thing we should mention on this program is that, let's say this unit only had a 20 bushel wheat yield. Your total payout then may go down to 60 bucks, but the premium goes down in step with it, so it might only be 8 bucks, and your net might only be $50. The point being is that the premium steps up and down with the liability in this program. It's not like your underlying crop insurance. When your yields get pretty low, your premium actually might go up because you're higher risk. And this is just strictly based off of what their liability is hanging in the back end there. So as the yields go down for you guys, the premium's just going to go down. And as the yields go up, the premium's going to go up right in step, which is, it makes this kind of a cool program for budgeting too. So Glacier County wheat, just SCO. This is winter wheat in Glacier County, $16 in premium paid in, $70 payout, and a $54 net. Glacier County barley. This is an interesting one. So you can see SCO would have only triggered once on barley for the most part back in 2005 here. And these are all 5-year history runs too, I should have mentioned, but still, with it only triggering once and ECO triggering 3 times, we still net out $48 above the premium that we paid in. So how about just SCO on barley when it only triggered once? So we went basically 5 years and only had this program really pay out once here, right? Still, you only had $16 in premium into it. There's a $26 payout. You still netted 10 bucks an acre above. So that the point of these slides is to show, to make this work, you can't jump in and out of this program. You probably should either be in it or not, right? Because you might have got paid this year and then not paid for a couple of years, but it's coming again when it's going to pay. And I'm going to show you why, because the years that it's not paying, those yields are ramping back up and they up your odds of getting paid, right? So this is Glacier County lentils. Lentils have been big return on a lot of these programs because the price fluctuated so much too, but $70 in premium, $155 in payout, so you netted 85 bucks an acre. Same thing on the Glacier County lentils and the SCO. It only paid 2 years, but you still net out $28 in premium, $64 payout, so a $36 net. It paid out over double still, or close to double, what you paid into it in premium, and it only paid twice, right? Here's Liberty County wheat, $13 in premium, $63 payout, or a $50 net. And then Liberty County barley, same thing, $78 of net return. Liberty County barley with just SCO was only a $39 net return, but your premium was less, right? I'm going to start rolling through these faster so that you don't have to sit through me rambling on all of these slides, but I really want to hone in the fact that I've run scenarios on every crop in all of our surrounding counties, and you're going to see at the end there's only one I can find that didn't pay a return here. So Liberty County lentils, $123 net return, triggered 4 out of 5 years on both ECO and SCO for that crop. Had you just been an SCO, which was our only option at that point, you would have had a $76 net return, 4 out of 5 years triggering. Here's Hill County wheat. Just SCO, it's $12 premium, $100 payout, so you would have netted $88 an acre over 5 years on wheat in that county. So good return in Hill County. Lentils, so if lentils trigger, smooth peas would probably trigger, and the chickpeas would probably trigger because it's based off the same yields. There is some price fluctuation differences, but when you're looking at lentils, just think of pulse crops here as far as your return on this program. But $57 in premium, $179 payout, so $122. Hill County Lentils, just an SCO, a $73 net, paid out 4 out of 5 years on only $22 in premium. And then Pend Oreille County. So now we're getting into counties that didn't have as bad a year, so that had better rainfall and stuff than what we experienced. So 5-year return on winter wheat in Pend Oreille County. We had an $18 premium, a $32 payout. And so, sorry, my slide's missing the net here for some reason, but you still netted out about $14 above what you paid in the premium, and it really only triggered 1 out of 5 years when you look at that slide. There was one little payment in 2015. So what's happening in those counties where it wasn't triggering is that the yields are ramping up, or they should be, right? So this final yield, this is what was actually harvested there in the county. So in 2015, we had a 36 bushel yield, 57, 42, 46, and 49. When this program was first getting started back in like 2015, you'll see our expected yield for the county was only 36. Because we've had multiple non-loss years with good yields, that yield keeps cranking up. So now in Pend Oreille County, your expected, or your base yield, your APH yield for the county, if you want to think of it that way, is now 44 bushels an acre. As that yield ramps up, your odds of getting paid go up substantially, right? And you know that these counties are going to cycle back into a drought cycle at some point. So if you're in a county where you run scenarios and it didn't pay for multiple years, that just means your yields are building in the background, and your odds of getting paid are probably even higher than some of these high loss counties going forward. So Pend Oreille County lentils, we've got $73 in premium, $286 payout. So in Pend Oreille County, those pulse crops triggered some huge payments, so $213 of net return over 5 years here. If you're just an SCO, instead of $213, now we've got $126 net, so it would have paid big to be an ECO and SCO together, but still good return on just SCO. Pend Oreille County barley, $67 premium, $115 payout, $48 net, and then just SCO would be a $15 net return because it only triggered 1 out of 5 years, but you still got back almost double what you paid into premium there. So the Teton County winter wheat, now we're getting into counties that had even better consistent yields. So you can see Teton County triggered 1 payment over here in 2019, some tiny payments in 15 and 17. It's $19 in premium, a $47 payout, for a $28 net. Here's an example of yields building quickly in a county. So this is Pend Oreille County, or Teton County's wheat yields. In 2015, you were at a 44 bushel, which is still pretty phenomenal for dry land. You see, because you've been pulling some incredible final yields off over here, it jumped up to 49 in 16 and 17. In 2018, it went now to a 51 bushel yield. You had a final yield of 53 again in that county for 2019. So we're working off some really high yield, back-end yields on wheat in that county because of the good years that we had, which makes it more likely to trigger going forward, right? The Teton County lentils, a little bit of a net return, $13 an acre. It really only paid totally out in 1 year in 2019. ECO triggered twice in 15 and 19. If you were just an SCO, you would have got a $10 net return there. So similar returns on these because they both only triggered twice, right? But still, you netted some dollars in the county. The last one, Cascade County, the winter wheat, $19 in premium and a $32 payout. If you look at my chart down here, it only would have triggered in 2019. So you went 4 years in a row, didn't get a payment out of this program, and it triggers once, and it nets a return for you over that 5-year period. So this is the one that didn't net any return when I ran it. So we got Cascade County lentils. You paid $44 in premium over that 5-year period, only got $31 in paid out. So you were at a negative $13 return on the product and a negative $11 return on the SCO. Point being now, so I ran all those scenarios, all those different crops in all of our surrounding counties, and the only one that didn't net a return was Cascade County lentils that I could find so far. So if you're in some counties where you run these scenarios and it didn't pay for 5 years in a row, that means you had 5 substantially good years in a row, and your yields should be built up pretty high in that county, which ups your odds of getting paid going forward. So this is just a probability bell curve. It just shows you that the closer you are to the mean of anything, the more likely it is that it's going to pay, right? So if you're at the 95% level, you're just right outside the mean of this. You should get paid basically every other year on ECO, especially because it takes into account revenue declines, not just yield, basically. So if you're an ECO, you should get paid every other year statistically on these crops. SCO would be farther down this line here, right? But it's probably more like 1 out of every 4 years instead of every other year. Still, these are good odds of a return on this program because the government's paying a good part of your premium too, right? So in summary, SCO and ECO provides excellent returns in tough years. It really is going to fill some gaps as far as losses go. Every scenario but Lentils and Cascade County paid out more than what was paid in premium. PLC appears to be the better choice for the FSA programs and allows you to still be an SCO. And if choosing one program over the other, let's say that you can't budget both of these, then I would always take SCO because it has the highest subsidy or the highest bang for your buck in these programs. I still think the combination of the two of them could be a real game changer if we have some bad years again, as far as it's not slipping backwards with the bank. But if you can't stomach that extra $5 or $6 an acre for the ECO end of it on these crops, then at least stick with SCO because that program seems to always pay a return because of the high subsidy rate. So eventually this program obviously will be posted on kwsumbers.com. We'll also email you guys with this presentation, which is probably how you're watching this now. And other than that, if you have any questions or you want to set up meetings with us, we're going to actually have a meeting scheduling app, appointment app, kind of like a dentist's office would work, just to keep us more organized during COVID, especially here, and to give you guys a chance for some one-on-one attention where we're not bugged by multiple customers at once. So thank you so much for taking the time to watch this. We really appreciate you guys' business, and hopefully next year's a little bit more of a normal year.